welcome to At Homes Radio. I'm Jenny Wood, Director of Happiness with At Homes Realty Group, here today with At Homes Director of Business Development, Dave Troop, and our At Homes broker owner, Elizabeth Cooper Golden. And we have special guest Shelle Nuepert with PNC Bank with us today to demystify home financing for us. Welcome, Shelle.
Thank you.
Let's talk about the first thing a home buyer needs to do before they even begin shopping for a home.
They need to get pre-approved for a mortgage. Pre-approved means that we pull credit, we look at your assets, we look at your payments, we look at your comfort levels. Pre-qualified is just a conversation with a borrower and what they are looking for and what they may qualify for. So it's important to get a pre-approval versus a pre-qualification.
So what will a buyer need to give you when they first meet you when they are applying for a home loan? What documents will you ask for them?
We need to see your pay stubs of the year to date, preferably tax returns and W-2s so that we can see a 2-year average. And then if you have a down payment, we need to see assets, your bank statements.
Tell me this, we have a lot of people that transfer into Huntsville with different jobs. It's the same career field, but a different company, and there might be a gap in employment for 2 or 3 months while they accept their transfer here. They have a contract. Will they qualify for a home?
Typically, if you're in the same line of work, you do qualify for a home. It is important to know that you have to have a 30-day pay stub from the company before you can close on your property.
I know that some people are hesitant to go straight to a lender because they feel like I might not qualify, so I don't want to get rejected. But how perfect does a credit score really have to be to get financing?
At PNC Bank, we require a 620 credit score.
Okay.
We do have circumstances where we can do below 620.
So if somebody has a 560 with some collections on it, what's the process for them to get turned around to where they are eligible to qualify for a loan?
If they're medical collections or small collections, the underwriter may not make them be paid off. Otherwise, you have to pay them. We can pay them at closing.
Oh.
If you're making payments on them, we'll take those into consideration.
What if they're disputed collections?
You may not dispute collections. You may not dispute anything on a credit bureau anymore. You either have to pay it or resolve it. And that is a new guideline where if you see disputes on a credit report, even if you have a 700 or over credit score, you have to fix that dispute. If a credit bureau has a dispute on it, it skips over that trade line and it doesn't account it into the score. So Fannie Mae and FHA have come back and said that they need to resolve all disputed issues. The word dispute may not appear in the bureau. If it is paid, it will say paid, zero balance, settled for less.
And that won't ding them at all on their credit?
Would not ding them.
Okay.
Now, if you have a couple $6,000, $7,000, $8,000 collections that you've paid for less, and not established credit, we may have underwriting see a problem with that, but settling as a zero balance is allowed.
I've been reading a lot about, and so have our consumers, there have been several articles stating that it is harder to get a mortgage now. Do you find that to be true? Is it really harder, or is there just more paperwork involved to get financing?
Not more difficult. We just need more documentation. For instance, if you have deposits on your bank statements that are not direct deposits from payroll or transfers from another account, you need to verify anything over $200. And also, we are trying to help the federal government with money laundering and drug trafficking. So, unexplained cash deposits, you have to verify where the money came from. It's called sourcing and seasoning your funds. And that can get hectic. We're trying to do better loans.
First thing I'm thinking about is 20% down. It's a common thing I hear even from first-time home buyers. Do we really have to put 20% down on a house to be able to buy?
No, you do not have to put 20% down. We have a program with as little as $500 down with a 660 credit score.
And no PMI?
No PMI. FHA is still 3.5% down. There is rural development for outlying county areas that is still 100% financing.
Talk to me about this $500 down program. That's pretty darn good.
It is income-based and it has some geographical-based areas. Basically, the borrower would call me and we would decipher between income or where the property is located. We put it in a geocoder to see if they qualify for $500 down.
Is this government backed?
No, it is. It is a held loan by PNC.
Let's talk about credit management. What is one of the, or several of the things that you see over the years consistently, mistakes?
To have what we call the perfect credit score, what people out there are aiming to get, a 720 or over, you should have a home loan and 2 other loans, maybe a car loan, student loan, and 1 credit card. And it's important that your balances on your credit card are at 50% or less. Anything over 50% tends to affect your credit score. A mortgage, of course, with no lates. Anything 30 days or older is going to ding your credit. Consolidate your student loans. We see all the time where people can have up to 15 to 20 student loans that they make one payment on, but they haven't consolidated them. The more trade lines you have, it appears that you have excessive debt.
Is there one thing that you see typically that kind of throws a little hitch in a get along there?
We like to see you have to have 2 years employment. A lot of times people, especially first-time home buyers out of school, you might have worked part-time 2 or 3 places. If you work somewhere for 3 weeks and you got a W-2, let me know that. Let me know your full 2-year work history.
My favorite glitch in your giddy up, is that what you called it, Jimmy?
Hitch in a get along.
And the lender pulls the credit the day before closing to see they now have $4,000 or $5,000 more in debt than they did when they applied for their loan.
Right. I try to tell my borrowers from the day you sit down and we pull your credit, do not buy anything else. So really start thinking about you're going to be a homeowner and money management and not incur any new debts. Don't go out and buy a new car. Don't. For one thing, too, inquiries to your credit can lower your credit score.
And I have a lot of buyers that aren't from the area and don't have relationships with bankers or local lenders. And each time they're inquiring with different lenders, they each want to pull their credit. Does that affect their credit score?
3 credit pulls typically is logical for mortgage shopping. So if you have ABC Mortgage, 123 Mortgage, and PNC Bank, it's okay. Any good lender, when you're doing pre-qualification, should give you a copy of your credit report and tell you what your credit scores are so that you can go ahead and shop rates. You can also go to myfreecreditreport.com. That's a good credit reporting agency that will give you all 3 scores. Typically, most companies use your middle credit score, so you can know what your credit scores are.
Let's talk about how to shop for a lender, because a lot of these, in particularly the government-backed loans, the rate is going to be the rate no matter where you go to for a lender, aren't they?
No. Rates typically today are somewhere 3.5 and below, especially on government rates. And it's a great idea to check with at least 3 lenders on what their rates and their fees are. Or I would compare actual fixed interest rates and closing cost and prepaids.
Let's talk the difference between closing cost and prepaids. That's a pretty important factor.
Closing cost is basically your cost of doing business. It's an origination fee, it is your lender fees, and it is your attorney fees. It's typical today for seller to pay closing costs. Doesn't always happen, but you really want to shop closing cost if you're paying the closing costs, not the seller.
Prepaid would be considered
your insurance and your interest. And interim interest is interest from the day the loan closes to the end of the month, which basically makes your payment for the following month. If you close in May, you don't have a payment in June. Your first payment is in July.
Typically, we hear the term junk fees. What are those all about, and what should buyers be looking at when they see these pop up?
You can incur an underwriting fee, a processing fee, a doc prep fee, a lender fee, credit reports. All those encompass what we call junk fees. You should expect to pay an appraisal fee, a credit report fee, and a tax service fee. Individual lenders have underwriting fees or processing fees, which are okay. You're paying someone to do a service. At PNC, we have one fee. It's $488. And then $12 for a credit report. And you should expect to see a tax service fee.
After the industry went head over heels, over rear end, over and over again in 07, 08, 09, nobody was closing on time. The industry got in a real upheaval. We were missing closing dates, missing multiple closing dates. Tell us a little bit about A, what was the cause of that, and what has improved things, and B, what do we do about it? How do we get to the table on time?
There's a lot that goes into a mortgage today. Like I said, we used to give me a pay stub and a promise, and we would close your loan, and then we got into the foreclosure mess that we're in today, which is getting better. So now we've gone back to old school, the way it should be. We want you to verify your employment. We'd like you to have a job. We'd like you to have some money in the bank and be a responsible person. Be prepared. Make sure you do have your pay stubs and you get information to your lender on time. We have to order an appraisal. There are a lot less appraisers out there today. We have appraisal management companies today. The federal government will not let you just order your own appraisal like you used to. So there's a lot more hoops that we have to jump through, a lot more people involved. PNC is committed to making a 30-day closing. We're so committed that we guarantee the borrower $500 if we miss your closing date. Everyone has to be responsible. You have to get me a contract on time when you're a realtor, an executed contract by all borrowers. You need to set realistic expectations. You really cannot close a mortgage today in less than 30 days.
Shelle, is there any advice or tips that you would give to consumers wanting to jump in but might be a little bit afraid, or any kind of red flags that you advise people to look out for?
I'd say just be a smart consumer. Take a look at your rate. Take a look at your fees. I would think it's more comfortable to do business with a local lender. It's always nice to come in and sit face to face. It's nice to know if they're going to service your loan. If you're in Huntsville or anywhere in the United States, if it's a big bank where you can come in and make your payment if you need to. You can come in and check on your account. Just be a smart consumer and make sure when you sit down at the closing table that you feel confident in what you're doing.
Special thanks to our guest, Shelle Nuepert with PNC Bank. Shelle, tell our listeners how they can get in touch with you or in touch with loan officers at PNC if they are ready to take that next step.
You may call me. I'm Shelle Nuepert at 256-653-4880, and we would love to pre-qualify you and pre-approve you at any time.
Fantastic. As always, you can also email questions to questions@homesradio.com. That's athomesradio.com. You can reach us directly also at 256-585-6000. And thank you for tuning in. We will see you next week on At Homes Radio on WVNN.